Morning, everyone. Thank you for joining us today. My name is Cami Kondolvi. I'm going to be one of the speakers today. I am the president and CEO of Condo Wealth Advisors. I am also a CPA and a certified financial planner. I've been with Condo Wealth Advisors since 2008. Since then, I've had the honor of writing a financial column in the Rafu Shingo, as well as the East San Gabriel Valley Japanese Community Center Exec. I've co-authored a book with my father, Alan. There, sorry, can you guys hear me better? I got a little ping. All right, I hope you guys can hear me better. I was just telling you about my background. It wasn't that interesting. But Alan will also be a speaker today. He is the founder of Condo Wealth Advisors. He is a certified financial planner and a chartered life underwriter. He recently transitioned from a full-time role to a consulting role. So now he's working on financial education and community outreach, a lot like what we're doing today. He was a 20-year columnist in the Rafu Shinbo, but also contributed to several community organizations through public education and writing. He is also an author on several financial planning books, including one on charitable giving. And I got the honor of working alongside my father for 13 years. So I'm grateful for his leadership and mentorship and to be able to continue working with him on things like this today. Before we jump into our webinar, I'd like to take a moment just to acknowledge that today is Patriots Day. It's a national day that we remember those that we lost on 9/11, as well as those who lost their lives, the heroes and first responders going to help those on 9/11. I know that I remember where I was this day 20 years ago, and I'm sure you do as well. So on this somber anniversary, I hope we can all just find some time to pay tribute to those fallen heroes, reflect on our many liberties and blessings, and work together to embrace peace and respect differences. And don't forget to hug those you love a little bit more today. So let's get started. These are just a few housekeeping items. I think we've been doing this for about a year, so probably all of you guys know this, but in the beginning, people used to ask me if we could see them. We can't see you, so enjoy your morning coffee, but you can contribute. Down at the bottom, there is a section where you can submit questions and answers. questions. We'll try and answer them at the end. Thank you to those who submitted questions when you registered, because that really actually helps to guide us as to what content we want to make sure we include in the webinar. For those of you who have questions real time, you can submit them at the bottom of the screen, and then those will get sent to us after we're done presenting, and we'll try and capture those. For those of you who have more individual, unique questions and you want a one-on-one consultation, let us know as well. Our information is at the bottom. We would be happy to do a free initial consultation for those who are interested, and hopefully we can be a resource to help you with your financial questions. So thank you for being here, and I will pass the floor to Alan to go over our agenda today.
Thank you, Ikemi. So this is what we're going to be covering today. The agenda sounds complex, but don't worry, we'll break it down for you. The first one is, how will Biden's tax policy affect me? So we're going to be covering the current tax proposals and who will be affected. And that's important because different proposals are going to affect different people. And if one or more of Biden's tax proposals is defeated, we might have to deal with how the current tax laws will change when they sunset in 2026. Then we'll discuss what changes you might consider this year before we get to 2022, because there are some strategies you might not be aware of that allow you to control how much tax you pay and when, such as realizing capital gains, accelerating income, and gifting assets. We know that COVID will continue to affect the market. We'll update you on what's happening right now. And the inflation that we're all experiencing, as you know, is pretty breathtaking. How long is it going to last? And in the midst of all this uncertainty, what is the long-term outlook? It's still possible to avoid pitfalls and take advantage of opportunities. So I'd like to pass it to Ikemi now, and she's going to tell you all about Biden's tax bills.
Okay, thanks, Dan. Let's get started on our first topic, which is Biden's proposed tax bills. The first is a $1 trillion, they're calling it bipartisan infrastructure bill, but it's also been referred to as the American Jobs Plan. As the title implies, it's much more focused on transportation, water, broadband. It was passed in the Senate on August 10th. Now it's gone to the House for approval. And Nancy Pelosi has said that they are committed to voting on it with hopeful passage of this bill and the next bill together in early October. The second bill is a $3.5 trillion budget plan. It has a lot of names. So sometimes it was called the Infrastructure 2 plan, the American Families Plan is often used, Rebuilding Plan, Reconciliation Plan. As you might see, it's much broader in scope, but if we were to narrow it down, it's focused on social programs and climate policy, and this bill has been passed in the House as of August 24th. So if you recap, you've got that $1 trillion infrastructure bill passed in the Senate. That has gone to the House. You've got this $3.5 trillion budget plan passed in the House. That has gone to the Senate. Now, this is where it gets a little bit tricky. Some Democrats in the House have said they won't pass the $1 trillion infrastructure plan without the concurrent passage of the $3.5 trillion budget plan by the Senate. Now, in the Senate, they're going to have to pass this with a very slim majority because Republicans have already said that they're not going to vote for this. That means they need every Democratic vote to get this passed as a budgetary reconciliation item. And there are already moderate Democrats who have voiced some concern or opposition to this, saying that the bill is too large, and they're concerned about the level of debt as well as inflation. So the reason I bring this up is because there's a lot of uncertainty as to whether one bill, both bills, or maybe neither bills are passed. But let's just say, for example, that both bills are passed and they're passed somewhat close to the proposed state that we've seen right now. Naturally, the next question is, how are these plans going to affect you? We can't cover all the details of the bills, but these are the things that I thought were probably most relevant to our audience.
The first is the corporate tax rate. 21% is the rate right now. Biden's plan is proposing that it goes up to 28%, but there are already rumors that this is going to get negotiated at 25 to get it closer to passage. The reason this is important to us is because if corporations are subject to higher taxes, even at just 25%, they're not going to stomach 4% less profit, right? They've got shareholders, boards, executives who very much care about the bottom line. So the thinking is that they're going to pass that tax expense to us, the consumers, in the form of higher cost of goods. Now, you think about this year where we've already had about a 6% increase in inflation. And then next year, if we were to add another 4%, that'd be 10% in a 2-year window. And that would be a lot for Americans to stomach. It might even start to have ripple effects in the market. And that's the broader picture of how this would inadvertently affect us. Other things, the top income tax bracket is proposed to increase from 37 to 39.6, and I'll talk about that one. Long-term capital gains, those are the taxes that you pay on the appreciated value of investments. The tax that's due, for example, when you sell stocks or you sell a house that you've appreciated. That could go up from 23.8% to as high as 43.4% on a federal level if you're in the top bracket, and that's including that 3.8% net investment surcharge. Step up in basis, it's allowed right now. It is proposed that it is not allowed in Biden's provision. Now, step up in basis is that provision that allows an inherited asset to go from one generation to the next, and at death, the value of that asset gets marked to the market value so that if the beneficiary sells it, they don't owe tax. So we'll talk about that one. Estate tax exclusion, that's also called the lifetime gift tax exemption. It allows you to gift as much as 11.7 million per person out of your estate during your lifetime before federal estate tax is assessed. It's proposed that that'll get cut in half. Itemized deductions are currently dependent on your tax bracket, but it's proposed that that is capped at 28%. Payroll tax, that's about 6.2% on the employer and the employee side. That stops when income hits 137,000. But the proposal is that there is no income cap. So as long as you earn income, that tax will continue, and that's absolutely purposeful. Social Security and Medicare are both facing long-term financial shortfalls. In fact, if we do nothing, it's projected that Social Security will start to default as soon as 2033. So that's why this item is on there. And 1031 exchanges. There is a current tax code provision that allows 1031 exchanges. That's the deferral of capital gains taxes on the sale of an investment property if the sales are used to purchase like-kind property. Under Biden's plan, that 1031 like-kind exchanges would be disallowed if you have more than $500,000 of deferred capital gains, or if you have more than $400,000 of income annually. So keep in mind that these are just proposals and they could change, but these are the things that you want to, listen for on the news as we start to see these laws get closer to passage. So let me break it down into kind of some major categories of who we think is going to be affected. And I'll get my little pointer out here. The first one is income, people who make more than $400,000 a year. That's because as an effort to combat wealth inequality, Biden is trying to increase the top tax bracket. It's actually $453,000 for single filers, $509,000 for joint filers. The IRS is projecting that's only going to affect 1% of taxpayers. The second one is people who have income of more than $1 million per year. And the reason that's relevant is that's when you trigger that long-term capital gains tax rate from the current 23.8% up to 43.4%. That's only supposed to affect 0.3% of regular taxpayers. So again, very little effect on the major population. And then estate tax exclusion would get cut down in half, although Senator Bernie Sanders has proposed lowering it even lower than the $5 million to, say, $3.5 million per person. Now, the one that I see affecting the most people is this possible elimination of the step up in basis. It's hotly contested, so there could be a lot of movement around this if it's passed. But what this means is when non-retirement assets like stocks or a house pass to the next generation, the assets basis may not get stepped up to current market value. Instead, when the original owner dies, the tax would be due by the beneficiary on the gain during the first owner's lifetime. And the tax would be due at the time of death. Right now, assets could get stepped up in basis. That means there isn't a tax liability. It would go to the next generation tax-free, and they only pay tax on the gain if there's gain from that stepped up value when they sell the asset. So this is a big deal. Tax would be due at the time that it passes to the next generation. However, there are some exemptions. The proposal is that there is an exemption of 1 million per person. So for a married couple, that means that if the first spouse passes away, their 1 million exemption could be ported or transferred to the spouse, so that when the second spouse passes away, they've got $2 million where they can shelter, let's say, stock portfolio or their home. Now, anything in excess of that would be subject to being taxed and would not get a step up in basis. But that first 2 million is protected, which is a substantial amount for most people. Now, there are exemptions to this rule, though. I looked at the roster and I know who's listening today. Exemptions to the elimination of the step up in basis rule includes family-owned businesses and farms if the heirs continue to run the business. So that's a huge benefit for family-owned businesses and farms. The other exemption is for assets that are donated to charity. So let's take that $2 million exemption, for example. Let's say mom and dad have a $2,200,000 estate. The first 2 million is sheltered, so it gets stepped up in basis, goes to the beneficiaries tax-free. That last 200 is going to be subject to those higher long-term capital gains taxes. You could donate that excess to a charity that would alleviate the beneficiaries from the tax, and the charity wouldn't have to pay tax on that gain because of their status. So it's a win-win. Of course, these are just proposals, and this is the one that I would follow the closest because I think there might be a lot of movement around it before it's passed. Now, Alan had mentioned in the agenda, we're talking about tax bills if they're passed, but what if they don't pass? Well, then we would just continue with the Tax Cuts and Jobs Act provisions that we're under now until those eventually sunset in 2026. So under the Tax Cuts and Jobs Act, a lot of people forget that actually every tax bracket was reduced. So when that expires in 2026, if Biden's law isn't passed, every tax bracket will go up. So like the 12% tax bracket will move up to 15, and 15 will become 22, and so forth. In Biden's bill, it's proposed that only the top tax bracket moves up and everybody else stays the same. The Tax Cuts and Jobs Act personal exemptions will return. So everybody was mad that their exemptions and their itemized deductions were taken away, and instead we got that really high standard deduction. That would be reversed. Everybody will get their exemptions back. The one that a lot of people care about, especially if you're in a high income, high real estate market state, is the 10,000 state and local tax provision. It's abbreviated SALT, but that capped us on deducting our property taxes, our mortgage interest, our state taxes. So we'll get to deduct those in full again. And then the last one, kind of interestingly, the lifetime gift tax exemption would go to 5 million with inflation, which gets us to 6 million, which is exactly what the Biden plan is proposing as well. So with that being said, are there actions you should consider taking before the new year? Now, remember, in the bigger picture of estate planning, the ultimate winner, I mean, I guess if this was a game, then the ultimate winner is not the person who lowers their tax for just one single year, but the person who lowers their cumulative tax paid over their lifetime. So that means strategically, you may actually want to accelerate tax 1 year, or you may want to defer it to another year in the future. And with estate planning, sometimes tax considerations are even made over multiple generations. So for example, one generation may take the brunt of tax so that the next generation gets a tax-free asset. Something to remember is that if you're going to realize or accelerate income as a tax strategy because you think tomorrow's tax rates are going to be higher, you want to realize income or capital gains, but not both because they affect one another. So for example, if you have high income this year because you accelerate income, you don't want to also sell stocks because the tax you pay on that gain is going to be at a higher rate because your income is high. So you want to do one or the other. On the flip side, if taxes are already very high and maybe you want to defer realizing income or taxes to another year, one example might be a retiree. Say you're a retiree and you've got a lot of control over your income. Maybe you reduce your taxable income by lowering your IRA distributions because those are treated as taxable income. Or maybe you delay selling stocks to to lower your taxes and take income from after-tax assets instead. Realistically, we're often somewhere in the middle. And that's not a bad place to be. In fact, it means you've got a lot of opportunities because you can do some good estate planning. So together, that's where we look at what's the tax code, what are your circumstances, and how do we use that to your benefit so that you can pass the most to your heirs instead of the IRS. So let's talk about that first strategy of accelerating capital gains taxes. Now, capital gains are probably going to be lower in tax rates this year than next year if Biden's taxes are passed. So if you've got a very large asset like a business or maybe an investment property that you're going to sell anyway, you know, it's imminent and it's just a matter of whether it's this year or 5 years from now, you may want to consider if you can close that transaction this year. Under Biden's proposal, taxpayers who report more than $1 million in adjusted gross income could be subject to that new higher tax rate. It's proposed to be 39.6. Currently, we're at 20. But adjusted gross income includes ordinary income from wages, dividends, capital gains, which could get triggered by the sale of these transactions we're talking about, business income, retirement distributions, and so forth. So if you don't plan carefully with a big sale like this, you could accidentally pop into that target group that Biden is trying to tax, and that could cost you dearly in the form of taxation. We mentioned that 39.6, there's a 3.8% surcharge from the government. Plus, if you're in California, you add in 12.3%, you're talking about a 55.7% tax on capital gains if you hit that $1 million threshold by accident. So if it's possible, try and close a transaction this year so that you get the lower 20% tax rates. If that isn't possible, maybe consider an installment sale. So you take the sale and you spread it out over a period of years, but something that keeps your income below $1 million every year so that you don't trigger this tax inadvertently. Individuals who are earning more than $450,000 a year, single, or $500 if you're a joint filer, if you think you're going to consistently be in that income tax bracket, it may make sense to accelerate what you can this year because you're going to save yourself 3% in taxes. So some things that come up often are Roth conversion, so moving assets from an IRA, a pre-tax account, to an after-tax account. Maybe you've got stock options that you want to exercise this year instead of next year, or a lot of clients have government bonds that stopped earning interest. It's been sitting in the bank. They haven't redeemed it because they don't want to pay the interest tax on it. Might make sense to do that this year instead of next year. The other thing is if you're a high income earner, you may also want to save your deductions for next year so that you can lower your taxes next year when tax rates are going to be higher. So say you have a big medical expense or you were going to do a charitable gift, you might want to lump those together next year to get the most deductions. Roth conversions have been extremely popular due to recent tax passage that eliminated the stretch IRA and kind of just consensus that we're probably going into a high tax environment. So in the past, you were able to do what was called the stretch IRA, or extend your tax deferral benefit over your lifetime and that of your beneficiaries. So say, for example, you got a $500,000 IRA, your beneficiary could inherit that IRA and they could take small required minimum distributions over their lifetime and essentially continue your tax deferral benefit. However, the Secure Act, which was passed at the end of 2020, now says that beneficiaries need to distribute that IRA within 10 years from the date of the original owner's passing. So for example, this orange yellow section up here, that's the benefit of an IRA with the stretch IRA provision. When you have to deplete that IRA in 10 years, which is this blue section, you can see the account gets depleted, the growth is cut off. There are exceptions who are still allowed to do a stretch IRA. So that's if an IRA goes to a beneficiary, if the IRA goes to a spouse, the spouse can continue that IRA in their own name. The second one is disabled beneficiaries. They're allowed to continue to do the stretch IRA, or if the beneficiary is not more than 10 years younger. So instead of like a child, let's say, for example, it goes to a sibling who's not 10 years younger than the original owner, they can do a stretch IRA. So let me give you an example. Remember this family? Ooh. Let's say that this mom has $1 million IRA and she's got one son. So she's going to give her IRA to her son when she's gone. Now, under the Secure Act, she can't give him an IRA that he can then stretch over his lifetime, which means he's going to have to take that IRA distribution over 10 years. Presumably, if it's a pre-tax IRA, he's going to try and stretch out the tax. So he'll divide that into 10 and take about $100,000 a year. But, you know, her son and her daughter-in-law, they're in their top income earning years. They've got a household income of $350,000 already. That means under the Secure Act, if they have to take a distribution of $100,000 per year, their income now looks like they're in the top tax bracket. They're going to pay 35% in taxes. Their total tax liability is going to increase to $99,000 a year on a gift. Now, if, for example, though, the mom instead converted her pre-tax IRA to a Roth IRA during her lifetime, essentially as a retiree, probably with the lower tax bracket, the son would still have to distribute her IRA by the 10th year. However, if it comes as a Roth IRA, the proceeds are tax-free. So maybe instead of dividing it out over 10 years and taking $100,000, he lets it grow for 10 years under his name, continues to grow tax-free under the Roth IRA titling. At the 10th year, he takes the full distribution. That is a non-taxable distribution event to him. So his taxable income is still $350,000 a year. His tax bracket is unchanged, and his tax liability is unchanged. In an annual savings, that might be $33,000 a year. Over that gift, that might be a savings of $330,000 a year. And that might be on the conservative side even, because I wasn't counting on that Roth IRA to grow as it was being invested for those 10 years. It could be that both of these accounts, once they're inherited, continue to grow and the tax savings is even bigger. Here's another example of accelerating income, maybe of interest to early retirees, which we're seeing more and more. A lot of people want to accelerate income between when they retire, and I chose 65 because that's when people are Medicare eligible, and a lot of people do. And 72. 72 is when required minimum distributions are required. Now, for a lot of people, their working income was high and their retirement income is a little bit lower. One strategy is to take this window from retirement and RMDs and accelerate your taxable income. So let's say somebody was earning $250 a year while they were working. Once a husband and wife are retired, they only have $150 a year of taxable income. They might want to spend these retirement years converting retirement assets from a pre-tax IRA to a Roth IRA. In this example, they could do as much as $100,000 a year. That would make their taxable income consistent to what it was when they were working. So from an IRS perspective, nothing has changed. But what it does do is all the assets they convert to Roth in this year, for the next 30 years while they're living and those assets grow, it's now in an after-tax bucket and the gain won't be taxed to them. If they don't use it during their lifetime, that will go tax-free to the next generation. And during the rest of their retirement years, once they're subject to required minimum distributions, the amount that they have to take out is going to be lower because you only have to take RMD on pre-tax assets, not on a Roth. So they're better able to control their taxable income in retirement as well. Oh, one thing I want to mention is that Medicare premium expenses are based on your taxable income. So if you do this strategy, you should be cognizant of the fact that you might be subject to, it's called IRMA, it stands for Income Related Monthly Adjustment Amount, but it is assessed on filers of more than 88,000 if you're single, or 176,000 of income if you're joint filers. Once you hit that threshold of income, you could be subject to a surcharge. That goes away when your income comes down, and it's averaged out over 3 years. And then another strategy, accelerating gifting. I'm going to kind of go over this one briefly because I don't think a lot of people are in this category. But if you were over the exemption limit, so 11.7 million per person, 23 million for a couple, or the new proposed exemption limit, 5 million per person, 10 million for a couple, you might want to consider gifting away assets that you were probably going to gift away anyway during your lifetime. If you're going to gift that asset to a family member, it makes sense to gift to somebody in a lower tax bracket so that the taxes that they pay on capital gains are lower. I saw one of the questions submitted at registration was about generation skipping transfers, GST. You can absolutely use this lifetime gift tax exemption to do generation skipping. So if grandparents are already planning on giving to grandchildren, you can use your lifetime gift tax exemption with this. They don't care if it goes to a neighbor, a friend, a daughter, or a grandchild. As long as you don't go over that limit, you're allowed to gift. So the proposal is going to be 5 million per person, comes up to 6 million with inflation. So about 12 million per person that could be done for generation skipping. The other thing you could do if you're above the limit and you were going to gift anyway is to utilize a donor advised fund or QCDs, qualified charitable distributions, because that's going to stretch your tax dollars. The charity won't have to pay tax on it. You can also have growth continue inside of those vehicles. So we've gone through a lot of different scenarios. You might be wondering who's affected, what strategies do you want to consider? Here are some estate planning strategies. The first thing is to remember that even though Nancy Pelosi has said they very much intend to vote on these bills, I think it was September 27th with final passage October 1st, I think that's extremely ambitious. The last two pieces of major legislation that we had passed were passed during the holidays. Secure Act was December 20th, Tax Cuts and Jobs Act was December 19th. That gave you like 5 business days between the holidays to actually get anything done if you needed to do something. So I hope it doesn't go that late, but start to get your ducks in a line with the idea that this might pass close to the holidays. So the way that you can give yourself opportunities is if you've got a business that you were thinking of selling, get an appraisal now so that you know what the liability is going to be around that. If you're going to sell real estate, get a realtor, start to take the temperature of the market. If you're going to do title changes, let your CPA and your attorney know now. They can run the tax liability for you. They can start to prepare the documents so that they're aware of your intentions and they're available to you if this hits the holidays. So now I'm going to pass the floor back to Alan to talk to you about COVID market recovery.
Thank you, Ikemi, for explaining the complex tax landscape ahead of us. Now let's talk about the market. How do we prepare for this kind of uncertainty? We thought by this point we were going to be done with COVID. We were getting back to normal, taking vacations and no longer wearing face masks. But then the Delta variant arrived. This year we're dealing with the Delta variant, but it's expected that if we can't get the virus to slow down, we're going to be dealing with a variant every year, and it's going to keep on getting stronger. So it's possible that COVID might transform our lives long term. It might not be just a 2020 or 2021 phenomenon. Another factor, the withdrawal from Afghanistan has dominated our headlines and affected the market. The U.S. ended the longest war in the country's history, but it's also increased instability in the Middle East. So military conflict is another thing that could affect our market. As Ikemi showed you, Biden's tax plans are going to have a clear effect on the future of the market. In addition, Fed Chairman Jerome Powell has been talking about cutting the Fed's bond buying program. The last time we did that out of a recession was 2014, and that was affectionately labeled the taper tantrum because the Fed was tapering down on bond buying. We had one of the worst years in the 2009 through 2019 market recovery. What will happen this time when the government starts to slow down federal stimulus money? Inflation is something that we're worried about as well. Is this inflation permanent? The government has said that this inflation is transitory or temporary, that it only relates to supply chain management issues and COVID. But what if it isn't? If inflation stays, how will that affect our economy? Are we going to see a global shutdown? Even though it feels like there's a lot going on, we've actually gone through this many times before, and that's because the market is very cyclical. There are some things that have changed. The span of the cycle has changed. It used to be that the market cycles every 5 to 6 years, but what we've seen in the last 2 or 3 decades is a stretching out of these market cycles. For example, we saw 1990 to 2000 being a great period, and then 2000 to 2009 was a slow period for the US, and then 2009 to 2019 was a great period again. So the thing to remember about market cycles is that when you're at the top, it feels pretty good. You just bought Bitcoin at 40,000. You feel fantastic. But actually, that's when the risk is the greatest. Because when the market starts to go down, you're thinking, oh, this is only temporary. But then it keeps on going down. And as you're on the way down, you're thinking, this is the time to sell. Because everything you hear on the news is bad. If you don't have the right portfolio, you might decide to sell right there at the bottom of the market, but you would have locked in your losses, not realizing that actually this is the greatest opportunity. We've all gone through this roller coaster before, and here's a chart of a moderate 60% equities, 40% bonds portfolio from 1972 to the present day. If an investor put $1 million into a diversified portfolio in 1972 and stayed invested to the present day, their portfolio would have grown to $65 million. But an investor would have to be disciplined and stay the course through some of these events. So you remember the horrible inflation of the 1970s? It was some of the highest rates of inflation in US history, with interest rates rising to nearly 20% due to central bank policy, the abandonment of the gold standard, Keynesian economic policy, and market psychology. And then in the Black Monday stock market crash of 1987, the US markets fell more than 20% in a single day. It's thought that the cause of the crash was precipitated by computer program-driven trading models as well as investor panic. Then there was the dot-com bubble and the subsequent burst in the 2000s. Then we had the Great Recession of 2008 and 2009. But despite it all, the market was resilient and a diversified portfolio came out on top. So one thing that might shock you is that to get those returns, you don't have to master market timing and stock picking. It's impossible anyway. The market rises and falls based on news, and news by its nature is unpredictable. Instead, you can have a diversified portfolio that allows you to get gains when the market is growing and protect yourself when the market is declining. Let's compare the annualized returns during the 20-year window from 2000 to 2019. The average stock picker got 4.25% per year. There were some years that you had 50% to 60% growth like 2020, but there were also years when you lost 30% like in 2009. So it averaged out to 4.25%. Even though the stock picker put in a lot of time, effort, and research, blood, sweat, and tears into their work, the return for a bond trader is even lower. What might surprise you is what would happen if you held a more diversified portfolio instead of stock picking. To make the comparison simple, we're just using the S&P 500, the 500 largest companies in the US. You don't have to do all that trading, you avoid all that stress, and you get a better return. The same thing goes for the bond portfolio. If you have a diversified bond portfolio, some short maturities, some longer maturities, it tends to weather out the volatility that we've seen in interest rates, and you get a whopping 5% average annual return compared to less than 0.5%. So the idea of spreading out your risk, not investing all in one asset class, not trying to time the market, it's a proven strategy called modern portfolio theory. And this was created at the University of Chicago by Harry Markowitz, Merton Miller, and Bill Sharp. In fact, they won the Nobel Prize for Economics for creating modern portfolio theory. And over time, it got even better because we can now combine this strategy with low-cost investment tools that were designed for modern portfolio theory. And these are called asset class funds. They can create optimum diversification with very little overlap. So modern portfolio theory doesn't just invest in the S&P 500. The US makes up 50 to 54% of our global capitalization. That's a lot. But as you can see, there's a lot of growth potential internationally as well. If we left out global investments, we would miss out on a lot of opportunities. For example, during 2000 through 2010, the US market had an average annualized return of negative 1%. Almost all the growth during those years came from international. And this chart shows how US performance and international market performance happen at nearly opposite times. And we could see it happening again today because the US market has already recovered. It's already been hitting new highs, and much of the growth has already happened. But international is a bargain. If you hold international as part of a diversified portfolio, you can still take advantage of future gains. Now, this is what we call a Skittles chart because all the colors look like Skittles. Each colorful box represents one of the major asset classes that we include in a diversified investment portfolio. The years are across the top, and the best performing asset classes at the top of the column for each year. The lowest performing asset class is at the bottom. The takeaway is that it's nearly impossible to determine which asset class is going to do the best next year. There are times like in 2009 when we went through a recession, the US market was among the lowest performing asset classes, and emerging markets was at the top. But then you'll notice a couple of years later, the US market was the top performer, and emerging markets was the biggest loser. And this keeps on happening. The worst performer becomes the best, and the best performer becomes the worst. And trying to predict the future of the market, that's a full-time job. Not only that, it's unreliable and really stressful. If you compare that with a diversified portfolio, which you see in white, to keep it simple, we're using a 60% stock, 40% bond portfolio, and we call that a moderately conservative portfolio. You can see that the diversified portfolio is right there in the middle. It's never the top performing asset class, but it's never the bottom either. And consistent returns are really important, especially if you're a retiree who's drawing income from their assets. This diversified, moderate, conservative portfolio had an annual return of 6.6%. The best performing year was 21%. The lowest performing year was during the Great Recession, but instead of being down 80% like emerging markets or 35% like the US market, you were down 20% because you had bonds to protect you on the downside. And that allowed you to stay in the market. This is why a diversified approach to investing gained nearly $2 trillion in assets between 2017 and 2019. That should tell you something. And in the same period, investors pulled $220 billion out of actively managed funds. So not only does diversification make sense, It doesn't require you to do much trading, so your costs are very low as well. And exchange traded funds have brought the cost down even further. By comparison, market timing and stock picking are very expensive. And whenever you can bring down cost, your performance is better. Market timing and stock picking are not very tax efficient either. Every time you buy and sell stocks, you trigger capital gains tax. Asset class investing also gives you the benefit of diversifying globally, so you're not just a US investor. Having international investments can help carry you through periods of slow US performance. Another big factor, we do regular rebalancing on our portfolios, and this strategy brings your portfolio back into your comfort level. And it helps you to sell assets when they're high and buy assets when they're a bargain. The long-term performance of a diversified portfolio statistically outperforms the indexes as well as actually actively managed funds. I mentioned comfort level. The first thing you can do to increase your probability for success in investing is to find the right portfolio allocation for yourself. It's great to be an aggressive investor when the market is doing well, but if you can't stick to that when the market is down, you're likely to cash out at the bottom. And that's why we do a risk tolerance questionnaire before we open every portfolio. You want to diversify between international and US stocks so that you could manage volatility over the long haul. And we also like to include smaller companies as well as value companies because those asset classes tend to be more dynamic and give you more bang for your buck. We know everybody is different with different goals. We look at where you're at right now and see what we can do to improve your situation. If you're doing great, congratulations. Maybe we just make your portfolio stronger and take advantage of tax code changes. If you're just starting out, we'll talk to you about how you can make the best use of your dollars and help them grow. Now, Akemi is going to talk to you about our holistic and customized approach.
Thanks, Alan. I'd be happy to go over how Kondo Wealth Advisors might be able to assist those who are interested in financial planning or any of the topics that we discussed today. I put our website over here in the bottom corner. Feel free to go there because all the things that we discussed, including a replay of this webinar, will be there. We also just redid our website, so we're really excited about it. So take a look. But Kondo Wealth Advisors, we are a goals-based financial planning firm. So unlike a broker who might only do investments or a life insurance agent who only does insurance and annuities, we're able to do all of that. And the way that we think we add value is that we incorporate all of your goals together. We look at the big picture and we see where each one of those makes sense for you as a tool to get you to your financial planning goals. So our 360 approach focuses on the key drivers of your life. We recognize that in your life, it's important to have balance, comfort, protection, and the well-being of the family. So that's why our approach is holistic, it's personal, and we really try to make sure that you're the center of that financial planning relationship. Each plan is an active blueprint, so we always want to make sure that we go back to it and we update it for your life events. And so it's a roadmap for all circumstances. Lately, our plans have focused on early retirement. We do a lot of retirement planning, but we're seeing baby boomers retire earlier than before and living longer than their future, than the generations before them. So that means we've got more years of planning to do. So retirement planning is some of our bread and butter, but we also look at existing portfolios. Like Alan said, probably a lot of you are already on track, but if we can do something to help you be the most efficient, we'd be happy to. We meet with our clients regularly. We can do that remotely. We can do that in person, but we want to make sure that your investment portfolio is on track and we can make adjustments as things are needed. To give you an idea of what it's like working with Condo Wealth Advisors, if you want a free introductory meeting, we'll use that as an opportunity for you to share what it is that you want to accomplish. We'll talk about our service offering and see if those things meet up. If you want to work with us, then we'll gather your financial paperwork, we'll analyze it and see where we can add value, and then we'll build a plan that incorporates your goals, your assets, and the recommendations that we think will help you get there. Once we get to a plan that you think accurately captures your goals, we'll then work to implementation. And I mention that because a lot of people don't think about it, but I think a lot of times implementing things is the hardest. So we can work as fast or as slow as you'd like, but we really want to make sure that you get there to the end successfully. Condo Wealth Advisors is a fiduciary. So the agents here, we are independent, meaning we don't work under the umbrella of a parent company like Schwab. We choose people that we want to partner with, but we register directly with the SEC and FINRA as our regulatory bodies. What that really means for our clients is that you guys are our only boss. Everything that we recommend is really because we've looked at the marketplace and brought the products that we think are best to you. And I think our philosophy sets us apart. We really want to give you peace of mind. We know that you worked hard for your money. We want to make sure that you have a successful retirement. In doing that, we want to make sure that we are always transparent in our working relationship with you. We value the trust that you give to us, and we want to do the best that we can. And we respect the cultural sensitivities and values that make you who you are. At Condo Wealth Advisors, we've been helping clients with their financial needs for 22 years. We hope that we can help to service you as well. So we're going to transition into our Q&A section. As I mentioned, those who would like to submit questions, it's at the bottom of your screen. A pop-up box will open. You can submit that question now and we'll get to it. And if you liked our webinar today, we will be doing another webinar in about a month from now, partnering with Little Tokyo Service Center. That one is specifically on charitable gifting. And I know a lot of people had submitted questions about charitable gifting. October is a great time, because at this point, you probably know what your finances look like for the year. You can give that to your CPA and determine how much you might be able to gift. And then we can implement those timely before the year is over. So we'll be talking about charitable gifting strategies from simple, moderate to complex strategies. This is the information. We'll send you an email about it as well, but it's a free webinar, so feel free to register. And so now let's move into some questions, and I'll pull those up. And Alan, do you want to start with this first one? It's converting a traditional IRA to a Roth can be a smart tax and estate planning strategy for some people, but for others, is it not a good strategy?
Like we mentioned earlier, these strategies are not a good fit for everybody. You know, some strategies work really well for a certain group of people. And the conversion from the traditional IRA to a Roth IRA, you know, it's a very powerful strategy. It works best when, one, if you start early. So, you know, if you're converting from a traditional IRA to a Roth IRA and you're pretty young, then you have many years for your Roth IRA to grow tax-free after you do the conversion. And time is a tremendous advantage when it comes to investing. The other situation where a conversion from a traditional IRA to a Roth IRA makes a lot of sense is if you're pretty comfortable financially and you don't think you're going to need to have to use any of the money out of your Roth during your lifetime. Because the Roth IRA is a great vehicle for transferring assets to children or grandchildren, or actually anybody that you would like to benefit in the future, because the transfer is going to be tax-free and the Roth continues to grow tax-free. So it's a tremendous advantage. It gives you a lot of leverage. Do you have anything to add to that, Kemi?
No, but there was another question that kind of piggybacked on this idea of Roth IRAs. One of the attendees said on that Roth IRA conversion chart that we talked about, where maybe you convert from age 66 to 72, what do you do if the pre-tax assets that you have are in 401ks? You know, how do you do this Roth IRA conversion strategy? So as you noted, 401ks can't go rolled over directly to a Roth. You have to have that IRA in between. So the first step is to consolidate those 401ks. A lot of people have that from several different owners, several different employers, and they all have been sitting out there. It might be nice for you as a retiree to get one statement instead of 6. So that would be nice. Consolidate those into one singular IRA. It's probably going to lower your cost as well. Most people don't realize that 401ks are actually one of the most expensive vehicles. They are categorized as educational instruments, so they go through a different standard or criteria of disclosure. But there was a Frontline documentary that talked about how expensive the fees are in 401ks, and that makes sense when you think about, you know, there's an HR department that services you, there's an investment team that manage it, then there's the investment funds themselves. So you're talking about 3 layers of fees to service that. So roll the 401ks from all those old employers into an IRA. You can then roll that into a Roth IRA, and you might want to strategize doing that over several years to not trigger all the taxation at one time. And if you've got other things like required minimum distributions or pension income, if you're doing Roth conversion during those early retirement years, it might make sense to push those off towards the end. Especially with Social Security, that's a guaranteed growth factor of 8% per year after your full retirement age. So that benefit is going to grow each year that you defer it. But if you trigger Social Security income, for example, at the same time that you're doing these Roth conversions, you're going to pay a lot more tax on the Social Security income anyway. So I would separate those two as a strategy. The next 2 questions, I'm going to kind of pair those together as well. One person is asking about, you know, diversification. That makes sense. I'm all on board for that. What do you do with the bond section, given that we're in this really low interest rate environment? What do you do to give you that safety net, but not, you know, get 0 returns in the market? And another question is asking, what do you think about real estate investments as compared to bonds? So I kind of paired those 2 together. I've heard those commercials on the radio as well, where they're saying, you know, don't earn, you know, 0.01% at the bank, do this real estate investment trust. And you could earn 6-7% per year. Of course, the ones that are paying the most are the riskier real estate investments. It's things like commercial properties, the places that people didn't go during COVID versus the REITs that pay less, are more residential, much more stable. You know, those things have their place in the market. They are not diversified. A lot of them are not liquid, which means you really need to be a very skilled, sophisticated investor to be in those and be able to stomach a lot of downturns. If you remember, REITs were also very popular in the mid 2000s, but then when the Great Recession hit, a lot of those REITs went bankrupt, and people couldn't liquidate them because they weren't tradable. So you have to be able to stomach some of that. You don't get extra return without the risk associated. Do you want to add to that, Alan?
Yeah, the commercials you hear a lot are, you know, they talk about the benefits, but they don't talk about the risk. And when you're generating really high income, you might be surprised how much risk you're having to take to get that income. And like Kemi mentioned, although they say guaranteed income, it's only guaranteed as far as the health and existence of the company. So you have to dig a little bit deeper, find out what the real estate is invested in, and ask a lot of questions about how much risk you're having to take.
Yeah, and then, you know, to go back to bonds a little bit before we move forward, I realize that the return on bonds is not what it was 10 years ago. So during the last recession, a lot of people moved out of equities and moved into bonds, and the bonds were paying 4%, 5% then, which was nice. Now those same bonds are paying about 1.5%, 2%, which is not ideal, but I do think it's temporary. I think that bonds serve their purpose. They're never the highest yielding or the biggest gainer inside of your investment portfolio. The reason they're there is for protection, so that when the market starts to pull back or corrects, those bonds, what everybody else is flooding into, you already have some of that in there. It shields you on the downside, and it allows you to stay in the market long term. So I really look at bonds as a function of staying invested in the market versus purely being an income generating or growth vehicle on its own. Let's see, there's another question here about what are the benefits that are going to be implemented for charitable contributions? I mentioned that we're doing a webinar on that in a couple weeks from now. Just to highlight a few things, there are some things this year that are specific to 2021. So for example, the CARES Act of 2020 had a provision where, as a direct gifter, everyday gifters, you could do $300 of direct gifts. This year that's been extended to $600 for a joint couple. So $600 of direct gifts, you can write a check, and it's an above the line deduction, meaning it's a direct reduction of your taxable income to the IRS, the same way an IRA contribution would be treated, where it erases income from the IRS's view. That's a fantastic benefit that is only going to last this year. It's not supposed to be available next year. There are other long-term things that you can do for implementing charitable gifting. The one that we see a lot of clients doing as a tool is to create a donor advised fund, for example, at the same time that you have a large taxable event. So let's say you sell a home. The first $250 per person is excluded from tax as the primary residence exclusion. But in Los Angeles, you can have a home that well exceeds the primary residence exclusion and exposes you to liability. Well, what a lot of people do then is they will fund a donor advised fund at the same time, put in a lot of capital in there, maybe the amount that they were going to gift the rest of their lifetime, but that donor advised fund contribution offsets the realized tax on the sale of the home, lowers your tax liability for that year. And inside the donor advised fund, you could put stocks and whatever is in there. That'll continue to grow in value, and you can gift from there the rest of your lifetime. So lots of charitable gifting strategies. Please go to that webinar if you're interested.
What I wanted to mention is that the donor advised fund is really powerful if you have appreciated assets, like an investment you've had for forever and it's grown a lot. And if you cashed out that investment yourself, you would pay a lot of tax on the gain. But if you donate that appreciated stock to your favorite community organization, not only do you avoid having to pay the capital gains tax, but when it goes over to the community organization, they don't pay any tax either, and they get the full amount of your donation.
Yeah, great point. Do you want to answer this question? One of our clients is asking what your views are on socially responsible investments. What have you heard about them? What do you think of them as an investment vehicle?
I like socially responsible investments. It used to be years ago that every mutual fund company had at least one socially responsible fund, but it was just one. And it was hard to get that kind of diversification and balance that Akemi was talking about earlier, if you only have one fund to work with. But things have really changed over the years, and now you can, there are whole fund families, and every fund is socially responsible. And so you have the best of both worlds. They're great investments. You can get very broad diversification, and you're investing in companies that treat their employees well, don't harm the environment, all these good things.
Yeah, and socially responsible investments, like you said, it used to be kind of narrow in scope. I think they've kind of evolved that SRI, socially responsible investments definition, to what is now kind of evolving as ESG, environmental, social governance. So really broadening the scope. President Biden's agenda, if those are passed, it carves out approximately $1 trillion for that environmental section of an ESG portfolio. So for example, retraining people who've lost their jobs in COVID into environmental and biosciences, putting money aside for renewable energies, government funds. If they're going to buy new cars, they've got to have electric vehicles. In this infrastructure bill, if they're going to do infrastructure, creating more charging stations. So there's a lot of money carved out for that. So it's not only something that I think aligns with people's beliefs, but it's also something that this presidential administration is focusing funds on. So it's also a good investment vehicle is what I'm trying to say. There too, I was thinking maybe we could start with this one. What is your outlook for another recession, Alan?
Well, the short answer is, yeah, we're going to have future recessions. And the reason for that is, Kemi had mentioned how the market is cyclical. Well, recessions are part of that cycle. They're bound to happen. It actually, keeps the market honest and healthy. Because if we just had, unlimited growth, that could be a problem. We need periods when the market goes down as well. So the way to prepare for a recession is to, in my view, to have a diversified portfolio. And that allows you to ride through the recession in a very safe way without having to panic and sell at the very bottom. So, don't worry about recessions. There are ways to take care of it.
Yeah, and I would agree with that. One of the other attendees was saying, like, there's a lot of buzz in the media, especially this last week. We didn't have a great week for the stock market, and everybody's starting to say these negative sentiments, like the market's going to pull back 10%, 15%. There's a lot of good reasons why that's true. There's a lot of not good reasons. Some people believe that September and October are down months. But when you're looking at the numbers, it does make sense from some perspective. Our US market, our investors are very ambitious / greedy. They jumped in to recovery before we were actually there, meaning as soon as they heard that the government was going to help support businesses and give people stimulus money, the market shot up. And we've waited for the economy to catch up to where the stock market is. Well, now with the Delta variant, the Mu variant, what we're realizing is that recovery isn't going to come as fast and as easy as we anticipated, that supply chain management issues may be prolonged as we go through different variants. I mean, you look at the cost of cars, they can't get chips to get in cars to sell cars. And therefore the cost of cars has gone up. So I think that is what the market is realizing, that some of that ambition needs to be tailored a little bit. And in my eyes, that's actually a really good thing because that prevents bubbles from forming in the market. Going back to our original discussion, why do you have bonds? That's exactly why, because you don't know when that correction is going to happen and you don't want to be surprised. You don't want to be in all equities while the market is good and then hurt when that correction happens. So you've got to have those bonds in there to give you that safety net in case that correction happens. And I think it's completely plausible, especially with people not reopening some of the targets for revenue that these corporations had that they were thinking they were going to book in Q4. They're already paring that down, which means the stock price of those companies is going to come down. So could we have a correction before year end? Absolutely. If Biden's plan passes, that could shift the market as well. So there's a lot of variables out there. There's a question specifically about family businesses. I will answer it quickly because I don't think it applies to everybody, but family businesses, if it passes from one generation to the next, the ruling right now, and it's just a proposal, is that they will be exempted from the step up in basis limit, meaning it doesn't matter if you're under the $2 million limit or above the $2 million limit. If it stays with the heirs, you're exempted. Now, how long that tail is, meaning can they hold it for 5 years like the Roth IRA rule and then be out of the window and sell it? I don't know. They haven't put details out on that yet, but I'll keep my eyes and ears open. Alan, there's a question. Where do you go to get good, dependable news media, to find out information on the latest, up-to-date info, non-biased information?
That's a difficult question. Whether you watch Fox News or CNN, there is a bias, and you're never quite sure if you're getting all the information that you need in order, especially if you're making decisions for your family financially. So, I would say you get a second opinion, like from your attorney or your CPA or your certified financial planner. And even better, if you can find a group of professionals that talk to each other, they put their best ideas together because the attorney is looking from the legal point of view, the accountant is looking from a tax point of view, and we're looking for what's going to preserve your financial security long term. And when those professionals are talking to each other to give you advice and uh, and make you whole and do the best for you and your family during your lifetime, that's probably the best solution.
Yeah, I agree. It's hard to find unbiased information, but it's always good to talk to a professional because their job is to give you unbiased advice, and pick out the pieces. Because sometimes, like you look at these legislative bills, there are thousands of pages. It's impossible as a regular consumer to go through all of that. So to go to a professional and have them try and target the pieces that are most applicable to you. Um, this one's about inflation. What do you think about hyperinflation? Would it occur given the new COVID variant, supply chain shortage problem, stimulus package? I think we talked about it a little bit. There's been 6% is the factor that they're using on CPI for this year. And CPI doesn't include things like food and energy and gas. If you're looking at the PPI, the purchasing price index, that's actually over 7%. And then we're talking about corporate taxes going up. So there's a big possibility. They said that we have not seen a year over year increase like this since the 80s. The worst was the 70s, but we could be going into a period of inflation. The government has said that if they see inflation being a problem, they may prolong federal stimulus. So that's one way that the government is trying to keep the market at ease so that it doesn't fall out, meaning they haven't done this taper tantrum that we talked about earlier. They just keep talking about it. Part of the reason they're talking about it is because if they do it, they don't want the market to be shocked and have a big correction like it did in 2014. Back then, that was considered a surprise. The market didn't like it. This time they've talked about it for 6 months and they haven't actually done it because what they're hoping is that by the time they actually taper their stimulus, it'll be a non-event. It's already priced into the market. But the Fed did say that if inflation becomes a factor that is prohibitive and it is not transitory, they will step in. I guess that's one thing to consider. The other thing is that inflation, as bad as it is still better than stagflation or deflation, which would be even worse. We look at countries who have gone negative on interest rates, and that is a hard hole to dig yourself out of. And so I think that is one reason that the government is leaning towards inflation versus those risks on the other side. Last question we have. Social Security running out by 2030 plus. That's the news. I saw an article about that last week in the LA Times. It is true that Social Security was geared to run out by 2034 if we made no changes. That means the Biden administration is in charge of doing something because the government budgets in 10-year increments, so that falls into his window. Now, COVID made that situation worse. Now they're saying 2033. That is a part of why these budget reforms are happening. They're trying to find ways to accelerate revenue. There's a lot of provisions against high income earners that are pushing them to pay more tax. They want to generate that revenue and use that to keep social programs open. The hard part is corporations. If they were to even tax, let's say, the big behemoths of the world, the top 5 tech companies, at a rate that was closer in line with small businesses, we would have enough money to fund everything, but they can't find ways to close gaps on that. A lot of businesses go overseas to Ireland where they can pay 12% taxes if we push too hard. So it's finding that balance of taxing America, taxing the high net worth, taxing corporations to keep those social programs open. I don't know if you have thoughts on that, Alan, but that's our closing question.
Yeah, I agree with what you're saying. I think the biggest financial problem for this country is income inequality and wealth inequality. Those corporations that Akemi was talking about, if they paid their fair share of tax, uh, it would pay for the entire U.S. educational system for 10 years. Uh, it would also, like Akemi was saying, we wouldn't have a problem with Social Security. There would be more than enough money. So, obviously things have to change. We're paying tax for those billionaires that don't pay any tax at all, and they're going to space. We're sitting on the ground baking. So, let, let's try to make things change.
Yeah, and with that, I just want to say thank you to all the attendees for being here. If you have specific questions that we weren't able to answer, please reach out to us because we want to be a resource to you and help get you on the right track. So thank you everyone for attending, and please go to the website for a replay of this as well as information about our next webinar. We hope to see you soon and have a great weekend.